Hello and welcome back to another episode of Money Illuminated, the podcast where we break down complex financial topics and we help you make informed, clear decisions. This podcast is for general information only. It isn't classed as financial advice, and all the information we provide was correct when recorded. In today's episode, we are talking about what is inheritance tax, and it's a very complex subject, so we're going to have several episodes on going into a bit more detail with this all. But as always, with me is Mr. Jack Saunders. Happy Monday, Jack. How are you today?
I am very good. Absolutely delighted to be back working after a weekend, as always. How was your weekend?
You sounded very positive then. That's good. I had a good weekend, thank you. So what did I do? I did a park run. So over the last couple of years, been trying to get into running, but taking it more serious the last several months. And for anyone that hasn't done a park run, it's kind of meeting. All cities have them, basically meeting up with loads of random strangers, and with volunteers there, you run a 5-kilometer race or run, I suppose. But the one in Portsmouth for me probably gets 400 to 500 people. So it's a big park run place.
Every weekend?
Every weekend.
Wow.
So I think this weekend it must have been close to 500, I would think. But got my personal best. And by the end, I had put my full body on the line and got to the end and had to basically fall on the floor to stop myself fainting or throwing up. But it's really funny with parkrun where basically you scan your chip at the end to give you your time and your place. So for myself, I feel like I've given absolutely everything to this. And then suddenly I get an email sent saying, you finished 208th. So there's people there running with their prams straight past me. There's a guy in this big inflatable dinosaur suit. And yeah, I feel like I'm close to death and I'm 208th just based on the easy amateurs that go to this park run every weekend. So yeah, it was a little disheartening, I must say.
Well, hey, listen, there's more people, a hell of a lot more people that didn't do anything like that at the weekend. And I would rather be in that camp myself, but take pride in the fact that you've gone out and ran rather than avoiding it.
Yeah, maybe I need to focus on myself, but the competitive nature of me it's a tough one to take on the chin.
Yeah, I get it.
Brilliant. Well, inheritance tax, very complex issue. So I think for our first episode around this topic, we're focused on, what is inheritance tax? What are the tax brackets? But I think a great place to start is just, what is this tax that I'm sure a lot of people have heard of, but don't quite understand. So inheritance tax is essentially a tax on someone's estate, including their property, their money, sometimes their pensions, and any possessions that they have when they pass away. So you only pay a tax if your estate overall is above a certain threshold, and most estates in the UK won't even get close to this number. However, it's becoming a bigger and bigger topic, and it's something that's going to be very, very important to a lot of people. So that is kind of what inheritance tax is, who collects the funds, HMRC do, and I think something that a lot of people don't understand is actually it's often before beneficiaries are allowed to receive anything from the estate. So it can cause a real issue for a lot of people. And that's why I think breaking this down in overall several episodes might be really useful to a lot of people. So from that side, Jack, would you mind just explaining who actually pays inheritance tax?
Yeah, of course. So it's one of those people. I think even we actually sometimes when we are talking to clients and families, we kind of say, in a way, beneficiary is paid by the beneficiaries. It's not technically paid by the beneficiaries. The estate is what pays the inheritance tax.
Yeah.
Often you've got executors or administrators who they almost execute your estate. They pull everything together. They collect all of the numbers, apply thresholds and things to it, and then they produce the final numbers for HMRC, who then receive the funds and collect the funds from the estate. At which point, once that's happened, the remaining estate can be distributed in line with whatever kind of estate planning and wills and all that sort of stuff that you have in place. I think we're going to do an episode on that specifically. or on just estate planning in general and what's important to think about. But yeah, the executor or the administrator, ultimately they are responsible for valuing the estate, looking at historic gifts and things that people have made, putting a final number in, submitting the forms, and then paying the inheritance tax from within the estate. And you have 6 months ultimately from kind of date of death to pay an inheritance tax liability. You can imagine that can be absolute hell on earth to do at a time where you're mourning your loved one's loss anyway. So it's incredibly sad and challenging. But gathering all of the details and finding out everything that people had, it's a really, really tough and mentally draining job. It's I don't want to have to go through it in my lifetime. I'm sure I will, but it's something that I would love to avoid at all costs if I could, because it's not fun. It can be difficult. So trying to make it as easy as possible for the people that are going to be dealing with it after you is something that actually is probably worth more thought than people give it, to be honest.
Yeah, absolutely. 6 months is just such a short period of time for the grand scheme of what we're talking about here. And I guess moving on from there, who pays the tax? Well, to begin with, you have thresholds. So everyone are entitled to thresholds. So what are the thresholds when we're talking about inheritance tax? Firstly, everyone's entitled to what we call the nil rate band. So the standard allowance is £325,000 per person. As with a lot of the other allowances in the UK, it's been frozen until 2030, 2031. So this is essentially that each individual can pass down up to £325,000 of assets before paying any inheritance tax. On top of that, if you are passing down a main home, a residence, to direct descendants, and Jack can go on to that in a bit more detail in a moment, you get an additional £175,000 to pass down. So from a single perspective, you potentially, if you're passing down a main home to direct descendants, you could have up to £500,000 to pass down to your loved ones before any potential inheritance tax comes into play. If you passed away and you are married or in a civil relationship and you have a qualifying partner, then essentially you both have those allowances. So there is up to potentially £1 million before anyone has to pay an inheritance tax bill should both of you pass away. Is there anything to add to that at all, Jack?
No, I think it's really, really well explained. And yeah, it's the typical scenario is that you're dealing with a married couple and you work the kind of estate planning correctly so that you have £1 million available. And like you said right at the beginning, most families aren't going to be at that level. But for those families that are at that level or more, it's really, really important. And it's not an easy number to get to, but it's becoming easier to creep up to that number now that from next April, April 2027, that is, value of certain pension benefits form part of that estate. If you've got death in service schemes through work and you pass away whilst you're working, that can add to the value of your estate if it's not structured correctly. There's lots of things that kind of make it worse than it looks originally for a lot of people. And I guess the other thing is the government, of course, want to get more tax out of people at all times because they enjoy spending a fair bit of money. So as much as the allowances are there, your nil rate band, the 325 that you, Elliot, went through, that's available per person for everybody. And there's no kind of tapering, that doesn't disappear for people. But the residence nil rate band, the additional 175 that each person can have if you leave your main home to direct descendants, children, grandchildren, people directly in your bloodline, essentially, that does taper away. If your estate gets to £2 million or more, you start to lose that allowance. £1 is lost for every £2 over £2 million that your estate comes to. It's a weird one the way it works, but all of a sudden, if your estate is 2.4, 2.5, 2.6 million, you can start to see actually you end up having not a lot of allowance. It's a hell of a lot of money still, don't get me wrong, but in comparison to the value of your estate, a lot of it could be subject to the tax rates. I guess that brings us on to the next part, Elliot, which is what is the tax rate people pay on anything beyond those thresholds?
Yeah, thank you very much. I think you're spot on. There are lots of different things that people probably aren't aware of that are going to form part of the estate, and all these extra tax brackets that people probably wouldn't even realize. So in terms of just the standard amount, anything above the thresholds that we've just discussed, you essentially, the estate would have to pay 40% income, well, 40% inheritance tax on. So, for example, if your estate for a joint couple, you have the residence nil rate band and you're passing that down to direct descendants, let's assume the estate was worth 1.1 million, then you've got the million to use up, but you're £100,000 over. So you're essentially your loved ones, your whoever are looking after the estate needs to pay a £40,000 tax bill on that additional £100,000 that you're over. On top of that, there is a way to slightly reduce it. So I think you came up with this, which is a very good saying. So HMRC is tough, but even they soften a little for charity. So they don't give you much here, but essentially if you provide 10% of your estate or more to charity, that 40% can reduce down to 36%.
It's a huge saving in the grand scheme of things. And I kind of, you can say that sarcastically, but in reality, we find it's more common than I expected it to be when I first became an advisor, but people are quite happy sometimes to leave 10% or more to charity, particularly if they've worked in sort of charitable organizations after they finished their careers and things like that. They're quite comfortable doing it sometimes because it then does drop that tax rate to 36%. And if you take that example of, or let's take your example, let's say you've got a £2 million estate.
Yeah.
The first million is tax free, the thresholds, it works like that. But that £1 million is subject to £400,000 of inheritance tax. But bringing that down to 36%, it does save a lot of money. 4% saving on that is £40,000. It is a huge number that people will save. So it is something that, don't get me wrong, not everybody does it, but more people will go down that route than I think people expect.
Yeah, absolutely. And I think with that, you mentioned it earlier, as of April next year, 2027, workplace pensions, potentially depending on the option that they go down, might form part of your estate as well. So when we're saying this doesn't affect that many households right now, I think that's going to completely change as of next year.
Yeah, and there's other little nitty gritty bits as well, but having a pension you've forgotten about from 15 years ago that's got a few £1,000s in it, well, if you don't think about what to do with those kinds of things from next April onwards, if pensions come into your estate for inheritance tax purposes and the executors kind of can't find a pension that you had from 20 years ago, that might delay the payment of everything and the process of going through probate. That might push you past the 6 months. And if you go past the 6 months that you've got to pay for things, pay for the inheritance tax, that can cause interest and fees and things to be added on. And it's similar to, and I guess this is a part of going through, how do you manage it? What kind of estate planning is sensible? But a lot of people are finding that they bought homes back in the 80s and 90s, just the rate of inflation across property has grown so much that £100,000 property 30 years ago might now be worth £1 million or more. If all of your kind of estate value or a lot of it is in property, that doesn't, HMRC don't just turn around and go, oh, it's okay, we'll let you have 2 years to provide the funds for the bill on the estate. They still kind of expect it to be in that 6-month period. So having careful planning way in advance of turning 80, 85, doing it when you're in your 50s and 60s or earlier, can help make sure that the people that are looking after your estate and going through the probate and the executors and things, it can help them make sure that they get things done in a difficult time more easily, but also try and keep them within those timescales to avoid having to pay even more money to HMRC. And let's face it, if we can do that legally, who doesn't want to go down that route?
Yeah, absolutely. And I think there'll be a lot more conversations like this with the news, especially in the budgets and so on. It's probably something a lot of people weren't even aware of. It's now really coming to the surface. So I think it's going to be a really hot topic over the next several years.
Yeah, for sure. Definitely.
Right. So I think we'll probably spend a full episode on how people can look to plan around inheritance tax and reduce potential inheritance tax bills that they might have. But for today's episode, should we kind of do a bit of a rapid fire as to, what things people can consider, what options there are available? I don't know if you would like to start us off at all, Jack.
Yeah, what are we just going to list one off each, or do you want to do a little game and see how many we can list off before we run out?
Well, let's maybe do 3 each, perhaps.
3 each? Cool, perfect. See, you're not the competitive type, are you? Well,
No,
you say that you
I
are.
don't back myself with this one. That's all.
Well, I guess there are definitely some more simple things that people are more commonly aware of, right? Things like gifting and the 7-year rule. So that's making significant gifts after 7 years. They fall outside of your estate and they're not included. But within the 7 years, they do still fall inside of the estate. It's a lot more complicated than that, I'll be honest, but it's one that we'll go into more detail at another point.
Yeah.
You've got things like annual exemptions. Everybody's got still reasonable levels, but you can do annual exemptions for £3,000 a year. You as an individual are allowed to gift away to pretty much anybody you want to. And that's just free of inheritance tax.
Yep.
You've got the small gift allowances within the annual exemption as well. It's £250 for a small gift. Again, can be to whoever, and you can do that as many times as you want to as well. And then you've got wedding gifts. You are allowed, believe this or not, HMRC like people getting married apparently, right? Which is weird because that can help you save more tax. But if your children are getting married, you can gift £5,000 to your child for wedding, £2,500 if it's a grandchild, or £1,000 if it's somebody else. So you've got the larger gifting, the 7-year rule. You've got your annual exemptions, which are kind of smaller numbers, but can make a difference. If you're doing those kind of things, maybe not weddings every year, but if you're doing your 3,000 every year and a couple of the 250 quid gifts as well, it can compound up to a hell of a lot of money saved. Yeah. And I guess another one I'll throw in is spend it. If it's not there for HMRC to get their dirty hands on when you do come to passing on, they can't inheritance tax it, right?
Yeah.
So yeah, spending it is one where we always talk to the people we work with on that front, just to try and get them into that mindset. The way I try to explain it is, look, if something's costing you £10,000 to do, think of the fact that it's only costing you £6,000 because you're avoiding that 40%, which, that might mean people end up buying an Aston Martin rather than a Volvo, but if that's what floats their boat, go for it.
I think you've picked the 3 almost nicest ones as well, because, can't speak for everyone, but you'd assume people want to gift the money to their loved ones whilst they're alive, and they want to see them spend it, and they want to see their money that they've worked hard for be put to good use, I guess. And spending it, obviously the best one. If they can spend it and the die with nothing philosophy, then it stops potential inheritance tax as well later down the line. From my side, I think insurance can be a huge one. So something a lot of people can consider is, if there is a tax bill in the future coming and you can almost plan around that, you can look into insurance that will essentially pay out a lump sum on death to help pay for that potential bill that you have. So that's a big one. We'll spend a lot more time on at a later date. Trust planning as well. This absolutely is something that you can speak about for hours and hours, but there's lots of different trusts out there of essentially putting money outside of your estate, depending on the trust that you have. There's complexities as well with that as to, does that remain something that you can change? Is it no longer yours? It can get very complex, but trust planning is definitely something to consider. And I guess I'm struggling a little bit on the third. I'll use, I guess, the residence nil rate band can be a bit of a cheat code, because in theory, that is an additional £175,000 each for people to, I guess, make the most of.
Yeah, definitely. It is one where, if you're not leaving your property to direct descendants in your will, well, guess what? You don't get that allowance. So it's 100% it's a planning opportunity. But yeah, unfortunately, you can't escape death, but you can certainly try and plan ahead and soften the tax bill.
A great saying. Okay, perfect. So I think in terms of that, what are some good tips for everyone listening? I think a big one that you mentioned already would be those small pension pots, they are going to be so important moving forwards to at least try and work out who the provider is, where they are. Are you missing any? That's a really big step here. A second would be potentially getting a valuation on your property, trying to work out how much is it worth now. And from there, hopefully, if you've got all your pensions, your savings, and your property, just rough figures, you can kind of find out, do you need to spend a bit more time thinking about this topic or not?
Yeah, definitely. And plan ahead. I would
Yeah.
100% say plan ahead. Make sure that you're thinking about this stuff way in advance, as with anything financial, really. Don't leave this stuff until you're too old to make a difference ultimately. Actually planning ahead and earlier than you expect to, it can make a monumental difference to the end result. And you know, the numbers are big, don't get me wrong, but inheritance tax is not it's not a tax for the ultra wealthy anymore. Because of the freezing of allowances and thresholds over the years, and values of assets and so on going up over so many decades, ordinary families are getting caught in this now. So don't ignore it. And ultimately, I guess the other thing is it's a voluntary tax, right? So planning ahead can mean that you avoid legally and completely sensibly paying inheritance tax through your estate when you move on and you pass. So yeah, plan ahead, get to grips with kind of the logistics of it and what it actually means for you, and hopefully save a fair chunk on the tax bill.
Yeah, absolutely. Okay, brilliant. Well, thank you very much for your time, Jack, and thank you for everyone listening. The next couple of episodes, we're hoping to get our estate planning team on so they can answer some key questions and break down a topic that even me and Jack struggle sometimes to break down clearly. So hopefully we'll have some really useful episodes for everyone listening soon. But for now, that's Money Illuminated. Thank you very much for your time.
Thank you.